Welcome to the HFR podcast. My name is Anika Akil, and I lead HFR Media. HFR is the established global leader in hedge fund data and analysis since 1992. To learn more, visit hfr.com. Welcome to the HFR podcast. I'm delighted to welcome to the show today Peter Berezin of BCA Research. BCA Research provides global investment research to clients across 70 countries, including 80% of top global asset managers. Peter is part of BCA's leadership team as Chief Global Strategist and Director of Research. He's helped to develop BCA's equity trading strategy service and has designed the firm's state-of-the-art quant model, Macro Quant. Peter holds a PhD in economics from the University of Toronto. And before joining BCA in 2010, he served as senior global economist with Goldman Sachs. Prior to that, he began his career at the IMF in program negotiations, surveillance, and research, working on the IMF's flagship report, The World Economic Outlook. Peter, welcome to the podcast. It's wonderful to have you on the show.
It's a pleasure to be on the show.
So, in preparation for our chat today, I had the privilege to preview a Back to the Future analysis of sorts that you guys have done for 2025. Which I have to say was probably the most entertaining piece of economic analysis that I've read in a while. So I have that at the back of my mind as I ask you, what are the cornerstones of the economic story for 2025? And why do you think that the global economy might be skating on thin ice?
Yeah, economies are inherently nonlinear systems, meaning that things can change very, very quickly. If you look at past recessions and what happened in the quarter or two leading up to those recessions, you very rarely see any indications of what's ahead. So what you have to do, we're based in Canada here, so I can quote Wayne Gretzky, rather than just sort of tracking where the puck is, you got to figure out where it's going. Like, where's the economy going? What are the forces that are going to shape growth over the coming months? And here I see things to worry about. I think that consumer spending is probably going to weaken because we're seeing a fairly substantial increase in delinquency rates, credit cards, auto loans, student debt. There are 10 million Americans who are delinquent on their student debt. And as of this week, that's going to start impacting their credit scores, which is going to limit the credit availability. All those pandemic savings, 2 trillion plus in pandemic savings, have been exhausted. That's 70% of the economy. And then you have kind of the housing market, which is really struggling. The number of housing units under construction is down 15% since the end of 2023. We're seeing very, very weak numbers in mortgage applications, reflecting the recent rise in bond yields. So I'm worried that the economy is not as resilient as people think. And I'm also worried that we could have a bunch of shocks over the coming 12 months that really do send the economy into recession. So we've got the tariffs, we've got the possibility of a further increase in bond yields as investors sort of digest the likelihood that Donald Trump is going to try to pass even more unfunded tax cuts. These are real risks to the stock market and to the economy.
Absolutely. So on that, if you think about the potential inflationary impact of tariffs and a situation where bond yields continue to rise, the housing markets are weak, what do you perceive as then the best defensive assets to focus on in 2025?
So usually bonds would be the defensive asset to own if you're going into recession. But the problem is that one of the reasons I think there might be a recession is that we could have a bond market riot that sends yields above 5%, perhaps as high as 6%. So you don't want to be in bonds at the moment. You don't want to really be overexposed to stocks either. So what should you do? Well, cash is a natural place to hide. Gold, I think, makes sense at the moment. So you want to be defensive. You want to be defensively positioned. If you're in stocks, don't keep buying like these small cap quantum computing stocks. They're down 50% just today. Go for the defensives. Go for consumer staples, which have gotten really badly beaten up. Go for healthcare. Go for utilities. You might not make a lot of money in those sectors, but you're not going to lose as much as you would otherwise.
Okay. Let's talk about currency markets for a second, which have been really wild just from the start of Monday, even. Can you lay out some sort of a story for where the currency markets go with tariffs and the offing and an inflationary environment? So, a high appetite potentially to inflate away US debt.
Yeah, that's right. So the US is more of a closed economy than many others. So disruptions to global trade, even if they emanate from the US in the form of higher tariffs, tends to impact negatively growth outside of the US more than US growth. And so when that happens, typically the dollar strengthens against other currencies. And that's what we've seen over the last few months. At the same time, higher tariffs will push up prices temporarily, but nevertheless, the Fed was badly burned by talking about how inflation was transitory a few years ago. If we have a transitory increase in prices due to those tariffs, the Fed may not be able to simply ignore it, which means that we won't get as many rate cuts as investors were hoping for just a few months earlier. And that's one of the reasons why bond yields have been going up. And unfortunately, those higher bond yields are going to exact a toll on growth. Housing is already weak. It's probably going to get even weaker. And the dollar itself, like the dollar is not a huge driver of US economic growth, but for the stock market, the value of the dollar is important because close to 40% of S&P 500 revenues are sourced from abroad. And when the dollar strengthens, that reduces the dollar value of those revenues and profits. So investors have not really priced that in. They should.
And do you perceive that the Fed will adopt an activist stance at all during 2025 and, further on into the administration, or do you think the Fed is just going to be extremely cautious?
I don't think they can be very activist. If, for example, we have a situation where Donald Trump tries to basically see how much he can get away with in terms of fiscal policy, tries to legislate all of these tax cuts while also rolling over the tax cuts that are supposed to expire. If the bond market reacts negatively to that, the Fed can't just step in and say, okay, we're going to do QE. We're going to buy government bonds. They have a legal mandate to maintain price stability. Debt monetization would not be consistent with that mandate. Now, at some point, if yields get high enough so that the economy is now kind of cruising into a recession, okay, maybe then the Fed will respond. But they're not going to do it at the current level of bond yields, that's for sure.
So, switching gears for a second, thinking about alternative investments, there's an ongoing trend to securitize private credit. Do you think that that can be an assist for corporations and U.S. economic growth? And on net, is that a positive thing, or what are the risks that you see underlying?
I think on net it is a positive thing because what we've seen over the last year or so is that bank credit growth has actually been quite weak, and companies, to the extent that they can, have been looking for credit from private markets, and in many cases getting it. What we don't know, because it's such a new area, is how that part of the market will hold up if there is an economic downturn. I mean, I'm old enough to remember how shadow banking brought down the global economy in 2008. Now, I'm not saying that what we have today is equivalent to that, but there are some echoes. This is a very opaque part of the financial system. So we don't know how well it will hold up. And by the way, on the consumer side, we also now have this proliferation of buy now, pay later lending going into this year, probably around $100 billion of lending has accumulated through that source. No idea how that's going to hold up. We could see a pretty big pullback in both the corporate and the consumer credit fronts.
So the greater deregulation that's impending, it seems, for both for tech and for fintech and crypto. Do you think that's a net positive? Where do you see that heading?
Well, it's hard to really value assets such as Bitcoin that don't have a cash yield. I mean, how do you value it, right? It's P divided by what? There's no earnings. P divided by trust. How much do you trust Bitcoin? I think what's going on now with Bitcoin and other cryptocurrencies is that there's a sort of a recognition that there is this market for assets that are unseizable. That if you're in some kind of despotic regime, you don't want your assets seized. Or if you're not in despotic regime but have engaged in some illicit activity, you don't want those assets seized. So what do? You buy Bitcoin. That is one source of demand. But of course, there's also another source of demand, which is just speculative activity. And that by its very nature is very fickle. I mean, if you look at the price of Bitcoin, it has actually tracked reasonably closely highly levered tech ETFs. If we get a pullback in the stock market, it's kind of hard for me to see how Bitcoin escapes that. And certainly some of the more speculative crypto names, sort of these meme coins, I think a lot of them are going to go down significantly.
Okay. So I'm still intrigued by the work that you've done at BCA and the macro quant model that you have. Again, thinking back to that note, I think that was quite fascinating. And I wanted to ask you, do you utilize AI in the macro quant model, or do you prefer sort of good old fashioned macro analysis when you're developing these predictions and forecasts?
I don't like black boxes. I like to understand why a model is sending the signal that it is sending so that I can sort of cross check the model's conclusion with my own. There's certain things that models will never be able to pick up. Like, how do you model what Donald Trump is going to do? Right? It's very difficult. How do you model how the Fed would react to a fiscal crisis when we haven't really had a fiscal crisis in the U.S.? That's very, very difficult to model. So the way I use these sort of models is as a tool for cross-checking my own views. If the model says one thing and I'm saying something else, I have to have a kind of a dialogue with the model and say, okay, do I really believe what I'm saying? Or should I re-examine it in light of the model's conclusions? And sometimes, that conversation is a very useful one because we're all very subject to these cognitive biases. You don't want to sort of change your view all the time because that's distracting. But sometimes you do have to change your view. And having a model there with a lot of data, and this model brings in like hundreds of leading indicators for financial markets, is extremely useful for me.
Absolutely agree with you. Having a contingent view of the world is absolutely, essential. If you look again, I know you've written the note, so you're looking at practically the year 2025 in the rearview mirror almost. What is the most likely state of the world you see materializing in 2025?
Unfortunately, I think, and I'm very much in the minority in saying this, I think this year is going to be a very, very tough year for equity investors. You've got the, I think, very real possibility of a major trade war, of a fiscal crisis at a time when the economy, as I mentioned earlier, is not particularly resilient. And all of this is occurring against the backdrop where equity valuations are very, very stretched. So my target for the S&P 500 for the end of this year is 4450. It's a very low number, but to get to that number, you don't really have to make any wild assumptions. All you have to assume is that the forward P multiple drops to about 17. Earnings estimates decline by 10% from where they currently are. That's not particularly challenging. The S&P was trading below a 17 PE for most of Trump's first term, and a 10% decline in earnings estimates when earnings are expected to grow 14% for the next 12 months would still leave earnings up for the year. So perhaps I'm actually too optimistic in my price targets.
You've spoken like a true economist. Well, Peter, thank you so much for joining us. It's been a pleasure. And for anyone who's interested in learning more about BCA Research's point of view, please visit their website. I'll put their details up on the screen in a minute. Peter, thanks again. It's great to chat with you.
It's my pleasure. Thank you.
We hope you enjoyed listening today. HFR is the institutional standard for alternative investing. Subscribe to HFR media updates on our website, follow our podcast for more exclusive content, and find us on LinkedIn and Twitter.